Welcome to the Nate Gratian Show. Let's talk about the history of the stock market. From origins to index funds and top lessons learned. The stock market's origins trace back to the need for businesses to raise capital and for investors to share in profits. This innovative concept revolutionized commerce and laid the groundwork for today's global economy. The Dutch East India Company became the world's first publicly traded company, allowing investors to buy shares and essentially own a piece of the enterprise. This pioneering move democratized wealth and investment opportunities like never before. With the success of the Dutch East India Company, the Amsterdam Stock Exchange emerged, establishing a centralized location for trading shares. This marked the beginning of modern stock trading, setting a model for future exchanges worldwide. The South Sea Bubble of 1720 provided a harsh lesson on speculative bubbles. Investors poured money into the South Sea Company, leading to inflated prices and a devastating crash, highlighting the risks of speculation. The Buttonwood Agreement, signed in 1792, laid the foundation for the New York Stock Exchange. This agreement among 24 traders created a more structured and regulated environment for trading, setting the stage for financial growth in America. The 19th century marked a period of significant growth and innovation in the stock market. Technological advancements and the expansion of the railroad industry fueled a boom in stock trading, attracting a broader base of investors. The panic of 1907 highlighted the crucial role of trust and liquidity in the stock market. A financial crisis precipitated by a lack of confidence among banks and investors underscored the need for a central bank. The Roaring Twenties brought an unprecedented stock market boom. This era of prosperity saw a surge in public interest and participation in the stock market, driven by post-war optimism and the advent of consumer culture. However, the Wall Street crash of 1929 abruptly ended this period of economic expansion, leading to the Great Depression. The crash was a result of speculative excess and lack of regulation, causing widespread financial ruin. In response to the crash, the New Deal reforms introduced significant regulations to the stock market. The Securities Act of 1933 and the Securities Exchange Act of 1934 aimed to restore investor confidence and prevent future crises. Post-World War II marked a significant shift in the stock market, with an unprecedented surge in individual investors. This period saw a democratization of stock ownership as economic prosperity and rising incomes made investing more accessible to the average person. The 1970s challenged this growth with a series of economic setbacks. An oil crisis coupled with rampant inflation introduced a new era of market volatility. Investors learned the hard way that markets could be unpredictably turbulent. The advent of technology in the 1980s and 1990s transformed trading, making it faster and more efficient. Electronic platforms reduced the need for physical trading floors, while computers started to play a crucial role in decision-making processes, setting the stage for future advancements in trading technologies. The late 1990s and early 2000s witnessed the dot-com bubble, an era dominated by speculative investments in technology stocks. The bubble's burst served as a harsh reminder of the risks associated with high speculation, leaving many investors with significant losses. The 2008 financial crisis, triggered by the collapse of the subprime mortgage market, led to a catastrophic market downturn. It underscored the interconnectedness of global financial systems and the domino effect that can lead to widespread economic turmoil. The evolution of high-frequency trading has markedly changed the landscape of the stock market. Utilizing advanced algorithms, these traders execute millions of orders at lightning speed, significantly impacting market liquidity and volatility. This shift has sparked debates about the fairness and implications for traditional investors, as the playing field seems increasingly tilted towards those with the technological edge. Exchange-traded funds, ETFs, have surged in popularity, revolutionizing investment strategies. By offering a blend of stocks, commodities, or bonds, ETFs provide diversification similar to mutual funds, but with the added benefit of real-time trading. Their rise signifies a shift towards more accessible and flexible investment options, appealing to a broad spectrum of investors from the novice to the seasoned. The introduction of Bitcoin marked a pivotal moment for the stock market, challenging traditional notions of currency and investment. As digital currencies gained traction, investors began exploring these new assets, leading to the creation of cryptocurrency-based funds. This movement has not only diversified portfolios, but also sparked a global conversation on the future of money and investment. Social media has transformed the dynamics of the stock market, empowering individual investors with information and platforms for collective action. The viral spread of stock tips and trends can now influence market movements, exemplifying the power of digital communities. This democratization of information, however, also poses risks of misinformation and heightened volatility. The GameStop saga highlighted a David versus Goliath battle, where retail investors, mobilized through social media, faced off against hedge funds. This event underscored the growing influence of individual investors and the potential for significant market impact, challenging traditional power dynamics within the financial world. The emergence of index funds has transformed the investment landscape, offering a simplified path for investors aiming for market average returns. These funds mirror the performance of a specific index, lowering the need for intensive stock selection. Vanguard stands at the forefront of the index investing revolution, making low-cost index funds accessible to the average investor. This approach has democratized investing, allowing more people to participate in the market's growth with minimal expense. Index funds have also sparked a debate on market efficiency and the role of individual investing. By investing in a broad market index, individuals can achieve diversification, reducing risk while still benefiting from market gains. One crucial lesson from the market's history is its cyclical nature, highlighting the inevitability of booms and busts. This underscores the importance of diversification and risk management in navigating the volatile landscape of investing. Another significant lesson is the long-term advantages of passive investing through index funds. This strategy emphasizes the value of patience and a steady approach to wealth accumulation, offering a buffer against the market's unpredictable swings. The importance of diversification and risk management cannot be overstated in the investment world. By spreading investments across various asset classes, investors can mitigate risks and reduce the impact of market volatility on their portfolios. Passive investing and index funds have proven to be beneficial for long-term investors. These strategies emphasize the advantages of riding out market fluctuations and achieving growth by mirroring the broader market's movements, rather than attempting to outperform it. The current state of the stock market offers a unique blend of opportunities and challenges for investors. With unprecedented access to information and trading tools, individuals can make informed decisions, although navigating through constant market changes requires adaptability. Technology and artificial intelligence are set to revolutionize stock trading further. By automating processes and providing advanced analytics, they offer the potential to enhance market efficiency and create more opportunities for investors to optimize their strategies. Looking ahead, the global stock market landscape presents both challenges and opportunities. As investors embrace the lessons from the past, including the value of index funds, they can navigate future uncertainties with greater confidence and insight.